picture this. It's the summer of 2022.
Oh, man, a brutal time.
Right. And you are a procurement manager from Ohio. You don't really care about geopolitics, you know?
Yeah, you just want your stuff.
Exactly. You don't spend your days pondering grand economic theories. You only care about missed shipments. So you're sitting in this highly polished, glass-walled conference room in Shenzhen.
I can picture it perfectly.
The tea is hot. The massive factory across town is, still running. But the line manager sitting right across from you is explaining for the third time why a component that used to reliably take 21 days to arrive is now taking 47.
Yep, that was the exact moment the world shifted.
Suddenly, the old certainty of global trade is just gone. Decades of this highly optimized just-in-time supply chain theory have seemingly burned down in like a single month.
Which is terrifying if your job is logistics.
Totally. Tariffs are baked in, shipping lanes are scrambled, and overnight, everyone from the compliance officers to the board of directors cares very deeply about exactly where your parts are coming from.
It was a huge paradigm shift for anyone managing a physical product. I mean, the spreadsheet in front of that procurement manager fundamentally changed right there in that room.
Because the old rules just didn't apply anymore.
Right. The defining question used to be, is China the most efficient place to make this? And historically, the answer to that was almost always yes, which made the job pretty easy, you know?
Right. It was a given.
But the new question became this incredibly complex matrix. Like, what does a second source cost? And how fast can they qualify to our standards? And most importantly, who can best absorb the political risk attached to every single purchase order?
And that actually brings us to the mission of our deep dive today. We're going to figure out what happened after that spreadsheet changed.
That's a fascinating story.
It really is. And to do that, we're diving into an incredibly insightful May 2026 article from the Substack called Equity Decoded by Spirit. The piece is titled The China Plus One Arithmetic. Because, well, there is a central mystery here that we need to solve.
The great narrative mismatch.
Exactly. The whole world has been talking about this China Plus One manufacturing shift for years now. And if you look at the financial press and the massive public announcements, India is absolutely winning the narrative war.
The headlines are massive.
Huge. But when you look at the actual factory floor right now, in 2026, Vietnam is the one quietly winning a surprisingly large share of the actual purchase orders.
Which presents this massive disconnect, right? Between public perception, what you might call the headline reality, and the actual industrial reality playing out in the supply chain.
And whether you are, actively managing an investment portfolio and trying to allocate capital, or you're just someone trying to understand how global trade actually works behind the scenes, understanding this mismatch is crucial. Okay, let's unpack this.
Let's do it.
How is it that a demographic heavyweight like India can be winning the narrative but losing the actual factories to a much smaller nation?
So, to understand the mechanics of that, we really have to start by looking at the foreign direct investment data, the FDI. This is where the public narrative and the factory floor reality first split.
Okay, leave the numbers on me.
If we pull the World Investment Report from 2025, it shows India received about $27.6 billion in inflows during 2024. Mexico secured roughly $36.9 billion.
Okay.
Meanwhile, Vietnam hit a record in 2025 of around $26 billion in realized investment.
Wait, let me challenge that premise for a second.
Sure, go ahead.
I'm looking at those numbers, and India's $27.6 billion is objectively larger than Vietnam's $26 billion. If we are tracking where the money is going to gauge who is winning, isn't $1 of investment just $1 of investment?
You would think so.
Yeah, I mean, it feels like we are comparing apples to, like, digital oranges here.
And that right there is the core of the definitional mess we're dealing with. Yes, $1 is $1 on a national balance sheet, but it behaves very differently in the physical economy.
How so?
Well, India's overall FDI pool is slightly larger, but it's incredibly broad. It is heavily weighted towards services, consulting, and domestic digital platforms.
Oh, I see.
Right. So $100 million flowing into a tech startup in Bangalore and $100 million flowing into a massive electronics assembly plant in Vietnam, they both count as foreign direct investment. But only one of those builds a factory.
Ah, so the digital dollar creates software jobs, but the manufacturing dollar creates tangible supply chain infrastructure.
That's the exact distinction. Vietnam's FDI pool, while lightly smaller in aggregate, is incredibly dense in what economists call tradable manufacturing.
Tradable manufacturing, got it.
Yeah, that is capital that actually turns into concrete being poured, 50-ton stamping presses being installed, and ultimately, physical container traffic leaving a port. India posts the bigger headline number, but Vietnam is capturing a remarkably manufacturing-heavy mix.
Okay, but let's strip away the digital services for a minute and just look at the actual factories being built. Because the very first thing I think of when manufacturing shifts from one country to another is labor costs.
Naturally, everyone goes straight to wages.
Right. And the source points out that the manufacturing labor cost in Vietnam is around $3 per hour. But in India, it's frequently much lower, sitting around $1 to $1.50 per hour.
It is significantly cheaper, yeah.
So if I'm that procurement manager from Ohio we talked about earlier, a 50% discount on labor seems like a massive insurmountable advantage for India.
It initially sounds like a total slam dunk. It's the first metric executives reach for when they want to cut costs, and honestly, it is consistently the one they misunderstand the most.
Really? Why?
Because the reality is that industrial buyers absolutely do not purchase labor hours.
What do they purchase then?
They purchase acceptable yield per hour, delivered flawlessly on schedule.
But wait, if India's labor is half the price, couldn't a manufacturer just, I don't know, heavily automate an Indian factory, use the math of labor savings to buy more robotics, fix the defect rate, and still come out ahead?
I mean, on paper, maybe. But if we connect this to the bigger picture of factory operations, automation just isn't a magic wand that works in isolation.
You still need humans.
Exactly. You can fill a room with robots, but you still need highly skilled local technicians to calibrate them, you need supervisory efficiency, and you need relentless line stability.
Okay, that makes sense.
A cheaper baseline wage doesn't help you at all if your defect rate is 3% higher, or if, say, a minor machine breakdown stalls the line for 2 days because the local supply ecosystem doesn't have the spare part handy.
Oh, wow. Yeah, a cheap wage doesn't fix a broken machine.
Right. So when a procurement model shifts from measuring raw wages to measuring actual usable output, that $1.50 wage advantage evaporates. Vietnam's higher base wage actually becomes the cheaper option because their ecosystem guarantees a much safer, more reliable yield.
That reframes the entire cost argument. I mean, it doesn't matter if the labor is half the price, if you have to throw away a quarter of the products, or if the shipment misses the boat entirely.
Exactly. Missing the boat is the ultimate sin.
Which actually brings up the physical infrastructure required to get that yield onto the boat in the first place. The source draws a really stark contrast here between the two nations.
Yeah, the logistics setup is night and day.
Vietnam has built these highly integrated export clusters. You've got Haiphong in the north, acting as this deep water spine linking directly to the electronics manufacturing in Bac Ninh. It's built specifically to move physical goods out to the world as fast as possible.
And if we look at what foreign buyers often encounter in India, the source describes it as a frustrating patchwork.
Frustrating patchwork. That's a great phrase.
It is. Now, to be fair, Indian infrastructure has materially improved. I mean, they've built dedicated freight corridors and modernized major ports. It's not stagnant.
Right, they are investing heavily.
But a world-class production plant in India can still easily sit isolated inside a subscale local logistics ecosystem.
So you're saying the factory itself might be a state-of-the-art marvel of efficiency, but the moment the product leaves the loading dock, it's a nightmare.
Pretty much.
Your goods move brilliantly on a high-speed rail line for 500 miles, but then they hit a local bottleneck and just sit on a truck for 4 days on a degraded dirt road just to cover the last 10 miles to the port.
And that exact scenario is what kills supply chain velocity. And we can actually quantify this friction.
Oh, there are numbers for this.
Yeah. A standard shorthand in economics is measuring total logistics cost as a share of GDP. In India, that sits around 8 to 9%.
Okay. In Vietnam?
In Vietnam, it's typically around 5 to 6%.
Wow, that's a huge gap.
It is. That percentage difference represents massive compounding friction. Vietnam's export-oriented corridors just feel significantly faster and cleaner to operate in for a multinational company.
And nothing sharpens this picture quite like the Apple supply chain.
Yeah.
I mean, Apple is basically the holy grail of manufacturing.
Oh, absolutely. They set the standard.
And as they diversify out of China, India has undeniably secured major iPhone assembly operations. You've got Foxconn and Sripperumbador, Tata Electronics taking over Wistron. It is genuine, massive, industrial-scale final assembly, that feels like a massive win for India.
It is a win, but what's fascinating here is what is happening one layer beneath that final assembly.
Okay, lay it on me.
Yes, India got the highly visible, headline-grabbing assembly jobs, but Vietnam secured the much denser, deeply entrenched component ecosystem.
The parts that go into the phone.
Exactly. We're talking about the internal acoustics for AirPods, the complex haptics for Apple Watches, and these massive networks run by companies like Luxshare.
I'd look at it like this. Final assembly is basically putting together IKEA furniture.
That's a good way to put it.
You get the instructions, you get the little Allen wrench, all the pieces are there in the box. It takes skill at scale, sure, but it's relatively fast setup. But component manufacturing is like actually milling the wood, fabricating the hinges, and forging the screws from raw metal.
Let's build on that IKEA analogy because it really highlights where the real leverage is.
Okay.
Final assembly can move across borders relatively quickly because the primary input is just labor putting pre-made pieces together. But components...
Much harder, I assume.
The qualification process for a component supplier is brutal. If an assembly worker makes a mistake, you swap a part. If a component manufacturer machines a hinge poorly, 1 million laptops fail in the field.
Oh, wow. Yeah, the stakes are way higher.
Much higher. When a country wins the components layer, they aren't just hosting cheap labor. They are hosting deep, verified trust. And that kind of trust is incredibly hard to dislodge.
Okay, so if it's so hard to dislodge, how did these countries compete for that trust in the first place? Because it's not just India and Vietnam in a vacuum here. Mexico wants these factories. Indonesia wants these factories.
The source explains this dynamic using global game theory, specifically a concept called an all-pay auction.
An all-pay auction. I know a standard auction is where the highest bidder wins and pays their bid. An all-pay auction sounds inherently riskier.
It is a brutal drain on national resources. Imagine 4 friends bidding on a $150 concert ticket.
Okay.
They all submit bids of around $100. But in an all-pay auction, everyone has to pay the $100 they bid, regardless of who actually gets the ticket.
Wait, really? So the 3 losers are just out $100?
Exactly, they get nothing. On a global scale, India is building massive industrial corridors and extending multi-billion-dollar subsidies. Vietnam is executing tax concessions. Indonesia is spending heavily on battery processing infrastructure.
So they're all putting their $100 in the pot.
Right. Every single country bears the immense upfront cost of preparation, funded largely by taxpayer money and investor capital. But at the end of the day, only one country gets the purchase order.
That is a staggering amount of financial risk.
Yeah.
So if India has paid a massive share of this auction cost, I mean, they've built the roads and offered the subsidies, why can't they just speed up their policy? Like, write a bigger check, clear the land faster, and force the buyers to choose them today?
Because of the second game at play here, which is first mover lock-in. Remember that trust we talked about with component manufacturing?
Yeah, the IKEA hinges.
Right. To get on an approved vendor list for a major American or European buyer takes 18 to 36 months of rigorous audits, pilot lots, process validation, and quality system checks. You don't just sign a lease and start shipping parts.
You're saying it's 2 to 3 years of bureaucratic and technical vetting just to be allowed to make the part?
Yes. And the years that really mattered for this China Plus One shift were not 2023 to 2026.
When were they?
They were 2017 to 2020, back when multinationals first started quietly looking for alternatives due to early trade tensions. Vietnam used those specific years exceptionally well.
You got a head start.
A massive one. They spent the time undergoing the audits and building the trust. India's making up ground now, absolutely, but no amount of aggressive government policy today can digitally compress the 3 years Vietnam has already spent proving they can deliver.
But wait, I have to challenge the idea that India's policy structure is just inherently slower. Because India has a unique internal dynamic.
You mean the states?
Yeah, you have all these massive states, Tamil Nadu, Karnataka, Uttar Pradesh, Gujarat, and they are all fiercely competing against each other to land these same factories. Shouldn't that internal free market competition result in better, more efficient deals for the manufacturers? It seems like it would force the Indian states to cut the red tape to beat their neighbors.
It's perfectly rational behavior at the state level. I mean, no chief minister wants to lose a massive electronics plant to a rival state. But the source argues that collectively, at the national level, this internal bidding war is deeply corrosive.
How does offering a better deal hurt the country, though?
Because the foreign factory simply plays the states against each other to extract more concessions, meaning the Indian taxpayer ultimately underwrites more of the cost.
Ah, a race to the bottom.
Exactly, and more importantly, for the foreign buyer, the administrative variance across different states is a nightmare. They have to navigate different labor laws, different local tax codes, and different environmental regulations depending on which state wins the bid.
That sounds exhausting.
It is. Vietnam, on the other hand, benefits simply from being smaller and highly centralized. They have fewer moving parts and industrial zones built entirely around a unified export logic rather than, federal bargaining.
They just offer an easy button. No interstate politics,
Yeah.
just a clear path to production.
That's the draw. Vietnam is operationally easier. And foreign buyers, especially when setting up a deeply complex factory in a brand new geography, highly prefer easy.
Here's where it gets really interesting, though.
Yeah.
Because listening to this, you might think, wow, India is just completely losing the manufacturing game.
Yeah.
But the author of this deep dive makes a massive pivot here.
A very necessary pivot, yeah.
Right. This isn't a story of India losing out entirely. It's a story of India competing in the wrong categories.
That is a crucial distinction to make. India is absolutely not losing the manufacturing future. It is simply losing the specific categories where raw cost, speed to market, and supply chain density are the only things that matter.
Like garments or light consumer electronics.
Right. But in other industrial categories, the axis of competition is entirely different.
So the buyer isn't asking who is the absolute fastest and cheapest.
No, not at all. In these alternative categories, the buyer is asking who is technically credible, who is politically acceptable, and who is strictly outside of China's sphere of influence.
The political risk matrix we talked about?
Exactly. And when those are the primary questions, India's proposition looks substantially better.
The source lists some incredibly specific areas where India is dominating. Defense-linked manufacturing, semiconductor packaging, pharmaceutical active ingredients.
All highly sensitive stuff.
Totally. Specialty chemicals companies like Navin Fluorine and SRF are specifically called out as prime beneficiaries. And data center hardware. Why are these specific sectors landing in India?
Because these sectors heavily reward what the source calls strategic substitutability.
That's a mouthful. What does that mean in practice?
It means they require massive geographic scale, deep engineering capability, rigorous regulatory compliance, and complex process control. Vietnam, for all its agility, just cannot always replicate massive, heavy industrial ecosystems easily.
They just don't have the sheer size for it.
Right. Plus, Western buyers desperately want this specific, sensitive capacity in a country that is large enough to actually matter geopolitically.
Okay, let me rethink my IKEA analogy from earlier then. Vietnam isn't a fast food drive-through for cheap labor. Vietnam is the highly tuned, ultra-reliable Swiss watchmaker of light components. They do the intricate, high-volume work flawlessly.
I like that.
But India is the heavy-duty industrial foundry. If you need a highly complex, heavily regulated chemical molecule or a piece of critical defense infrastructure, and you absolutely must protect your intellectual property from geopolitical rivals, you go to India.
That captures the dynamic perfectly. In those high-stakes categories, the West has fundamentally decided that Chinese dependence itself is the primary problem.
The risk is too high.
Yeah. India's real edge there isn't low cost or an easy administrative setup. It's the fact that they are a highly capable, massive democratic alternative that can absorb immense scale.
Let's pivot to the listener's wallet for a second, because this is where the theory collides with actual money.
Yeah.
How are capital markets treating this reality in 2026?
Well, this is where things get a bit concerning.
The source points out a huge disconnect here. Indian investors are treating the China plus one narrative like a broad index trade. They are throwing 40 to 70 times forward earnings at capital goods and electronics manufacturing companies in India.
Which is wild. A valuation multiple of 70x only makes financial sense if revenue visibility is perfect, margin durability is exceptionally high, and the whole painful qualification cycle we discussed earlier has already been completely de-risked.
But in 2026, for many of these Indian manufacturing companies, absolutely none of that is true yet.
None of it.
The source uses Dixon Technologies as a primary case study. They sit right at the intersection of wild investor enthusiasm and strong government policy support, and their stock is trading at a massive premium. But why is it dangerous for investors to price these companies for absolute perfection right now?
We can break this down using a standard discounted cash flow, or DCF, model.
Okay, take us back to finance class.
This is the bedrock of how analysts value a company based on the money it will make in the future. Let's use a concrete example. If I promised to give you $100 today, you'd happily pay me close to $100 for it.
Sure.
But if I promise to give you $100 in 4 years, you might only pay me $60 today because of the time value of money, right? The risk that I might just, not pay you.
Right. Money in the future is worth less than money today,
Hmm.
especially at, say, a 12% discount rate.
Now apply that to these factories. As we discussed, just getting the vendor qualification takes 18 to 36 months of audits and pilot runs. So there is zero real revenue generated during that time.
Just crickets for 3 years.
Exactly. Then, once approved, the revenue ramps up very gradually over another 2 to 3 years as the buyer adds a second line or slowly increases their order volume. So those meaningful cash flows, that $100 we're talking about, don't actually begin to materialize until year 3 or year 4 of the relationship.
So the market is actively pricing in immediate, massive scale that simply does not exist yet.
Right. They're pricing the stock based on the headline announcement today, completely ignoring the 3 years of financial friction it takes to actually build the parts.
That is the valuation trap. Investors are confusing a very real but very slow corporate procurement decision with the highly optimistic PowerPoint valuation model.
Perfectly said. Markets price the narrative on the day of the press release, but the actual cash flow only arrives after years of audits, pilot runs, and immense customer patience.
So what does this all mean?
Well, if we connect all of these threads, it leads to a grand synthesis of the entire China plus one dynamic over the last decade. Vietnam has spent the last 10 years becoming operationally inevitable in categories where friction kills deals.
They made themselves the easy button for the supply chain.
Exactly. India, meanwhile, has spent that exact same decade becoming strategically indispensable in heavy, complex categories where global politics shape the procurement spreadsheet.
Operationally inevitable versus strategically indispensable. Those are two totally different global games.
Very different.
And India's biggest pitch to the world right now is often simply that it is massive, it is democratically aligned, and above all, it is not China.
It's a powerful pitch, and honestly, it might be enough to win several strategic sectors and justify their immense industrial subsidies, but being a geopolitical hedge is not the same thing as being a true, friction-free manufacturing superpower.
You still have to build the roads and pass the audits.
Exactly. Eventually, at some point down the road, buyers have to choose India because they simply cannot ignore India's technical capabilities, not just because they fear China.
And that leaves us with a lingering, slightly uncomfortable thought to chew on. If India's current manufacturing boom and these massive 70x stock valuations are heavily subsidized by the West's intense desire for a geopolitical hedge against China, what happens to those valuations if global tensions ever cool down?
It's a scary thought for investors.
Or what if the geopolitical spotlight shifts to an entirely different part of the world and that not China premium suddenly vanishes?
Poof, gone.
It's something to think about the next time you hit buy on an emerging markets index fund, or, the next time you picture that procurement manager from Ohio sitting in a glass conference room just trying to figure out how the world really works.
It is a vastly more complicated world than it was in 2022.
It certainly is.